Here's something that does not add up at first. New cars are more expensive than they have ever been. The average new car in America now sells for just under $49,000. Dealerships are making record amounts of money on every single vehicle that rolls off the lot. And yet, almost every major car company on the planet is quietly bleeding cash. Honda just posted its first annual loss in nearly 70 years of business. Stellantis, the company behind Jeep, Ram, and Chrysler, recorded one of the biggest losses any automaker has ever reported outside of a full-blown recession. Ford wrote down close to $20 billion. Even Porsche and Ferrari, the brands that print money in good times and bad, have watched their profits and their stock prices fall off a cliff. So how is that possible? How can car prices be at all-time highs while the companies selling those cars are losing more money than ever? And more importantly, what does any of this mean for you, the regular person who just wants a reliable car you can actually afford? That is exactly what we are breaking down today. Because once you understand what is really happening behind the scenes, you will look at your next car purchase completely differently. You will know when to buy, when to wait, and how to avoid the financial traps that are catching millions of people right now. Welcome back to Net Worth Nation. Let us get into it. First, let us clear up the biggest myth out there, which is that cars are expensive because nobody is buying them. That is backwards. Car sales recently hit their highest level since the pandemic. Worldwide, more new cars were sold than before the pandemic ever started. So this is not a story about empty showrooms. People are still buying. They're just paying a lot more to do it. Back in 2019, the average new car cost around $38,000. Today it is just under $49,000. That is an $11,000 jump in just a few years, and that is before you add interest. So when it feels like cars have gotten wildly more expensive, you are not imagining it. The price tag really has climbed, and your paycheck probably has not climbed at the same speed. Now here's where it gets strange. If companies are selling cars at record prices and pulling in record revenue, you would expect them to be swimming in profit. Instead, many of them are drowning. To understand why, we need to look at the single biggest bet the car industry made over the last decade and how badly it went sideways. That bet was electric vehicles. For about 10 years, nearly every major automaker became convinced that the future was fully electric and that it was coming fast. They watched Tesla's stock price soar, and their own investors started demanding the same thing. So they poured tens of billions of dollars into building electric cars. New factories, new batteries, new technology, entire production lines designed to pump out hundreds of thousands of electric vehicles a year. And then reality showed up. It turned out the demand was a lot softer than they expected. The early adopters who really wanted an electric car had mostly already bought one. As more electric models flooded the market, it did not create a wave of brand new buyers. It just split the same group of buyers across more and more options. On top of that, in America, some of the government incentives that made electric cars cheaper got cut back, and gas stayed relatively affordable for a while, which gave people one less reason to switch. And so now you have these gigantic factories that were built to produce 1 million electric trucks a year, and they are only making a small fraction of that. A factory that is barely being used is worth a lot less than a factory running at full speed. So one by one, the automakers had to admit that a huge chunk of the money they spent simply is not worth what they thought it was. Honda pointed to the billions it spent getting ready to build electric cars it now will not sell. Stellantis took around $25 billion in write-downs as it backed out of its electric plans. Ford admitted its electric division alone lost almost $5 billion in a single year. General Motors quietly scrapped its plan to go all electric and wrote down billions more. Here's the part most people miss. A lot of those terrifying loss headlines are companies cleaning up their books all at the same time, on purpose. If everyone in the industry records a giant loss in the same year, no single company looks like the failure. They're all doing it together. But make no mind, that does not make the losses fake. That was real money, spent on real factories and technology that is not paying off the way they promised. And that money has to be earned back somewhere. Often it gets earned back from you, the customer, through higher prices. So that is reason number one. Prices are not coming down. The companies are trying to recover from an enormous, expensive mistake. But there is a second force at work, and this one hits your wallet directly. It is the car loan trap. Let us talk about how people actually pay for cars now, because it has changed in a way that should worry everyone. The average monthly payment on a new car recently hit $773. Read that again. The average. And 1 in 5 new car buyers is now signing up for a payment of $1,000 or more every single month. That is a mortgage-sized payment on something that loses value the moment you drive it off the lot. How are dealers getting people to agree to payments that high? Simple, they stretch the loan out longer. After refinancing, the average car loan now runs more than 90 months. That is 7.5 years of payments on a car that is steadily falling apart and falling in value the entire time. Stretching the loan makes the monthly number look smaller and more affordable, but it means you are paying interest for years longer, and you spend a huge part of that loan owing more than the car is even worth. That brings us to one of the most dangerous traps in personal finance, and it is more common than you think. It is called negative equity, and it just means you owe more on your car than the car could sell for. Right now, roughly 31% of people trading in a car toward a new one are underwater on the old loan. The average amount they are underwater is around $7,200. Here's why that is so dangerous. Let us say you owe $7,000 more than your car is worth, and you decide to trade it in for a newer one. The dealer does not just erase that $7,000, they roll it into your new loan. So now you are financing a brand new car, plus the leftover debt from your old car, all stacked on top of each other. You start the new loan already deep in the hole, and if you do that twice, 3 times, you can end up trapped, perpetually owing thousands more than anything you own. This is how regular, hardworking people quietly dig themselves into a debt spiral, one trade-in at a time. And it is getting worse. The share of borrowers falling behind on their car payments recently hit the highest level in more than 30 years of tracking. People are stretching to afford these vehicles, and a growing number simply cannot keep up. Now let us add electric cars back into the picture because there is a specific warning here. Electric vehicles are losing their value faster than gas cars. Over 5 years, the average electric car loses around 58 to 59% of its value. A comparable gas car loses closer to 45%. So if you finance an expensive electric car on a long loan, you are combining the 2 worst ingredients for negative equity: fast depreciation and slow repayment. That does not mean electric cars are a bad choice for everyone. For a lot of people, they make great sense. It just means you have to go in with your eyes open about resale value, especially if you tend to trade cars in every few years. So we have covered why prices are high and why loans are a trap. Now let us zoom out to the third force, which explains why you are not seeing a flood of cheap new cars to rescue you. In most of the world, something dramatic is happening. Chinese automakers have exploded onto the scene with electric and hybrid cars that are shockingly good for the price. A company called BYD delivered around 2.6 million vehicles last year and now controls roughly a fifth of the entire global electric car market. Another company, Xiaomi, which did not even make cars 5 years ago, delivered over 400,000 vehicles in its first full year, and one of its models outsold the Tesla Model 3 in China. In places like Europe and Australia, these affordable Chinese cars are pouring in and putting real pressure on prices, but here in the United States, trade barriers and tariffs keep most of them out. That protects American jobs and American car makers, which is a real benefit. But it also means we live in our own little bubble, where we do not get access to a lot of the cheaper options the rest of the world is suddenly enjoying. So while car buyers in some countries are about to see prices pushed down by new competition, American buyers are largely shielded from that downward pressure. For us, that means do not count on a wave of cheap imports to bail you out anytime soon. The fourth and final force is a wall of debt that is about to hit. A huge number of car loans were written a few years ago, back when interest rates were near zero and monthly payments were manageable. Those loans are now expiring. If those owners want to upgrade to a similar car, they face a double whammy: a higher sticker price than before and a much higher interest rate on top of it. That makes trading up painful. Many people will look at the numbers, realize a newer car would cost far more per month for barely any improvement, and simply decide to keep what they have. And that, weirdly, is the smart move for a lot of folks. Cars are lasting longer than ever. A well-maintained vehicle can easily run for well over a decade now. So if your current car is safe, reliable, and paid off or close to it, the financially sound choice is often to just keep driving it. The car you already own, with no payment, beats a shinier car with a $773 monthly bill almost every single time. So let us bring this all together into what it actually means for you. Number 1, do not believe that prices are about to crash. The forces pushing car prices up are stubborn, and in the United States, we are insulated from the cheap competition lowering prices elsewhere. Buy based on your needs and your budget, not on a hope that prices will tumble next month. Number 2, the loan term is everything. If a dealer can only make the payment work by stretching it to 7 or 8 years, that is a giant red flag that the car is too expensive for your situation. A good rule of thumb many people use is to keep the loan to 4 years or less. If it does not fit in that window, look at a cheaper car. Number 3, protect yourself from negative equity. Never roll old car debt into a new loan if you can avoid it. If you are underwater on your current car, the best move is usually to keep driving it until you have paid it down, rather than trading it in and stacking the debt. Number 4, if you are buying electric, plan to keep it for a long time. Fast depreciation only hurts you if you sell early. Hold on to it, enjoy the lower running costs, and the resale hit matters a lot less. And number 5, the boring car you already own is often your best financial asset. No payment, no interest, no new debt. In a market this expensive, doing nothing is frequently the most powerful money move you can make. The car market is going through one of the strangest stretches in its history. Record prices, record losses, and a whole industry trying to recover from an expensive bet. But you do not have to get caught in the middle of it. The people who understand what is happening are the ones who keep their money, while everyone else signs up for payments they cannot afford. So here's my question for you. Are you planning to buy a car in the next year, or are you holding on to what you have got? Drop it in the comments. I read every single one, and I would love to know which camp you are in. If this helped you see the car market a little more clearly, do me a favor and hit that like button, because it genuinely helps the channel grow. And if you are new here, subscribe and join Net Worth Nation, where we break down the money stuff nobody taught us so you can build real wealth one smart decision at a time. Thanks for watching, and I will see you in the next one.